How is everyone doing tonight? We are in the strategy room on this Saturday night, November 15th, 2025. You are with the banker next door, Dr. Joe Berquist, and it's so great to be back in here tonight. It's been a couple weeks since I last was on here with everyone. So it is fantastic. I just want to give a shout out real quick to all my buddies. Last week, I actually took a trip to the Big Easy. I went to New Orleans for the first time in my life, and it did not disappoint. It was an absolutely once in a lifetime trip, absolutely fantastic time. Again, just give a shout out to my buddies out there. They know who they are. But I have a wonderful show for everyone this evening. We're going to be talking about Fed interest rate decision for December. I got a lot of tariff update news. Obviously, the shutdown came to an end this week, as everybody is aware of. A lot of banking news, a lot of things happening overall, just in the banking world, as it were. We're going to be talking a little bit about mortgages, some of the things going on in the residential mortgage world as far as what our home builders doing. So we got a lot of great stuff for tonight. And so we are going to jump into it as we usually do, taking a look at the U.S. debt clock and just seeing how we're doing here with everything. So U.S. national debt is still cruising over $38 trillion. The U.S. federal budget deficit has not really moved much, still sitting at 1.7 trillion. To the negative for the U.S. federal budget deficit. The Doge clock, interestingly enough, the goal has gone up to $711 billion, whereas the Doge clock now is up to $214 billion. The debt to GDP still hovering in at 121%. That actually notched up a little bit since the last time we were on here 2 weeks ago. Let's see here. Anything else? Credit card debt still hovering at 1.2 trillion. And I don't think anything else on there earth shattering. Not too much change there. So, want to jump over here. This got messed up to X for just a second here because we're going to be talking about some of this stuff as we go through the night here. So I just wanted to talk to this. So this was a study that was just released by the San Francisco Federal Reserve Bank just a couple of days ago. And this looked at 150 years of U.S. tariff policy. And one of the very interesting things that they found is that tariffs actually lead to lower inflation. And you can see that here in the chart right here to the left. And I know this isn't like super blown up. You can't really see it that great. But the other thing that they looked at is that tariffs also lead to higher unemployment. And obviously with the unemployment market looking a little shaky at the moment, definitely something to look at and consider. So I will be covering that report in a separate episode that I'll probably put out, if not this week, probably next week. But I just wanted to show this to everybody because I thought it was a really interesting study that they put out there. I don't know if anybody has ever actually seen this chart. So this was hiring by corporate America, basically since February of 2020, and this is a pretty wild chart here. So, and if I'm gonna actually try to see if I can blow this up a little bit more there, maybe so people could see that a little bit better. But basically, you can see here that white people actually lost 904,000 jobs, whereas Hispanics gained 2 million. Blacks gained 768,000, Asians gained 882,000, all workers basically up 4 million. Now, this was from, this is basically in 2020, the year after Black Lives Matter protests, the S&P 100 added more than 300,000 jobs. 94% went to people of color. Now, you might say, like, well, why is that why is this interesting, or is this earth-shattering news? Well, the problem is that 70% of the population still made up of white people. So, but 94% of their hiring went to just, probably a little bit less than 30% of the population. So there is just an enormous disparity there. This was a chart that I actually saw a couple years ago, but it started kind of making the rounds on social media again this week. And I just wanted to show it because it was a mind-boggling chart when I first saw it. I was just like, that can't be right. And sure enough, yes it is. All right, here. Did I jump back too far? I think I jumped back too far. Hold on. Okay, let's go. Let's go down here. Some other stuff. Um, Hedge fund borrowing by source. Maybe get into a little of that. Um, 2 trillion in new debt here. Borrowing to fund AI data center spending exploded in September and so far in October. You can see here. I mean, it's just this astronomical amount of spending here. It's a pretty wild. BlackRock faces 100% loss on private loan, adding to credit market planes. Another of those. I had to laugh. Here it says isolated event. I was going to say one-off events. So about a month ago, BlackRock deemed the private debt it had extended to Renovo Home Partners, a struggling home improvement company, to be worth 100 cents on the dollar. As of last week, the firm had a new assessment, zero. The drastic revision comes as Dallas-based Renovo, a roll-up of regional kitchen and bathroom remodeling businesses created by private equity firm Audix Group in 2022, abruptly filed for bankruptcy last week, indicating it plans to shut down. BlackRock held the majority of Renovo's roughly $150 million of private debt, while Apollo Global Management's Midcap Financial and Oak Tree Capital Management held smaller chunks, according to people with knowledge of the matter who asked not to be identified, discussing a private transaction. So yes, another one of these one-off events here. You can see another failure on the books here for BlackRock. And then let's see here if I thought there was one other thing. Yeah, so we'll come back to that. Okay, so let's roll on here. I wanted to show everybody this chart. Now, this is a chart of the overnight repurchase agreements, the repo market chart, if you will. Now, I showed this to everybody a couple of weeks ago, and we've had some pretty wild things here. So these spikes are basically and as I explained a few weeks ago, what has happened is the Federal Reserve has drained almost all of the liquidity out of the repo market. And I've been pointing this out for months now, saying that this was going to become a very big issue. And we could see here just in the last couple of weeks, if you look to the right here, you see all these little spikes here. All these little spikes are liquidity injections into the repo market. And you can see here, like on September 30th, you had 5 billion go in. On October 15th, 4.75 billion. Then a couple smaller spikes, $3 billion, $3 billion, $3 billion. And then on Friday, October 31st, you had this massive one, an almost $30 billion injection required on Friday, October 31st. And that's pretty wild. And then we just had on Wednesday, we had another $4.2 billion, injection in the markets. But the problem is that this is starting to become a big issue. And there was just another article that just came out basically saying that there was an emergency meeting on Wall Street this week that was called by the Fed to basically discuss this very issue. And I've been saying for months, like, this is going to become a problem. Like, why the Fed deemed it a smart idea to drain all the liquidity out of the repo market is completely beyond me. But this is going to become a bigger and bigger issue over the next few months. You're going to start to, and again, I'm going to be showing this every week, and I'm going to show everybody. And I truly believe here over the next couple of months, you're going to start to see these spikes are going to get worse and worse. They're going to become more frequent. They're going to get bigger. You're going to have more volatility. You're going to have, up and down, up and down. And this is something we're really going to have to keep an eye on, because this is going to become an issue. And I've been saying that. And this is why the Fed, when we talked about at the 2 weeks ago, when we talked about the Fed's last rate cut meeting, one of the critical things that Jeremy Powell said in his press conference after the rate decision was that he was going to stop the quantitative tightening. He was going to stop the reduction of the Fed's balance sheet. That's what this is. Now, reducing the balance sheet is great. The problem, the side effect, if you will, of reducing the Fed's balance sheet is this. It's that they drained the liquidity out of the repo market, thus draining the liquidity out of the market itself. And I'll give a plug here for the Lords of Easy Money. If anybody has never read the Lords of Easy Money, if you have not seen any of my series on the Lords of Easy Money, I highly suggest you go watch it, because that series explains all of this. They explain all the history of the Fed for the last 15, 16 years, explains how we got here, how the Fed actually put the repo market at the center of the financial system. Again, go look up the Lords of Easy Money. Get that book. If you have not read that book by Christopher Leonard, I tell people it's one of the best books I've read in the last 20 years. You've got to go read it, because only through understanding that can you really understand why a lot of this stuff is happening in the economy today. So again, these spikes we have to keep an eye on, because I think for better or for worse, they're going to get worse. Okay. Let's take a look at interest rates real quick. How are interest rates doing this week? We actually saw a little bit of a spike up this week in the 10-year Treasury note. We were, like I said, we were looking for 4%. We had gotten to 4%, and now this week we jumped up to 4.147%. It was actually a tad bit higher, a little over 4.15%. And we'll have to see here. Obviously, there was a little uncertainty in the market this week. We had a lot of earnings that came in from the big seven, from a lot of the big AI players. Meta, Google, Tesla, Amazon, all the usual players, usual suspects. But what really came back on these earnings was the capex. It was this just out of control, completely insane spending right now on the data centers, on energy, on the data centers. That is literally unsustainable spending. But not only is it unsustainable spending, nobody really knows if they're really going to see the return that they're hoping for on this spend. And that is what has had Wall Street all jittery, for the last few days, and why part of the reason why we saw this little spike up this week. So now, do I think things are going to calm back down a little bit? Yeah, I think things will probably calm back down a little bit as we head toward the end of the year here. But again, in looking at other rates, I mean, everything kind of spiked up just a tad this week. You can see here from the chart here on the right, you see these little spike ups over here. So we get again from 3.6 up to 3.614 on the 3-year note. 2-year note. I mean, everything's just up a tad, not much, nothing to panic about, nothing to be concerned with, but just something that I wanted to point out. And then we see the 30-year bond here. 30-year bond might have seen the biggest jump up here from 4.7% to 4.75. Definitely saw one of the bigger jumps here on the long end of the curve, as they say, with the 10-year and the 30-year. All right, so we'll mosey on from that. So you took a look at interest rates. All right, now, so how are community banks doing? How did community banks? I just wanted to show this one article here from S&P Global. So community banks margins expand, credit quality is holding up for now. So strong net interest margins have supported earnings at U.S. community banks in 2025, and earnings growth should continue in the coming quarters, even as credit costs continue to migrate higher. So community bank margins have expanded as the benefit from fixed rate assets repricing has overshadowed modest increases in funding costs. Community banks in aggregate reported strong earnings growth in 2025, but the pace of earnings growth is anticipated to moderate in 2026 due to the higher credit costs. Credit quality is expected to slip as the lagging impact of tariffs could slow economic growth, impact consumer spending, and increase delinquencies, necessitating higher reserve builds. Now, the only thing in here that I don't agree with is this lagging impact of tariffs. Like, no, if credit quality slips, it's going to have absolutely nothing to do with tariffs at all. I don't understand why a lot of this commentary, you just continue to see these. They love the tariff word. They love they just want to slip the tariff word in all the time. Oh, well, the lagging impact of tariffs. And they're like, no, like this has nothing to do with tariffs. Credit quality is all about the decision making that banks make in underwriting and approving their loans. It has nothing to do with tariffs. The credit quality And I don't think community banks really have too much of an issue to worry about with credit quality. Yeah, I mean they might have a couple issues here and there, but I think it's the bigger banks. I think it's the J.P. Morgans, the Bank of Americas, the Wells Fargos, all the bigger banks that were involved in this whole, the whole private credit market. I think that they have far more to worry about than because the community banks were not involved in the private credit market. They weren't involved in lending money and getting in with the NDFIs, the non-depository financial institutions. Also, getting involved with the hedge funds and the private equity funds that were involved in all that. So I don't think the community banks overall have a lot to worry about. There might be some credit quality as it relates to some commercial real estate, maybe a little bit of what you call C&I lending, which is commercial and industrial lending. But overall, I think they're going to come through this pretty good. I'm like I said, I'm keeping a bigger eye on the bigger banks because this subprime market that we've seen blow up so far with the failure of First Brands and Tricolor Holdings and Prima Lend and just a number of different companies here in the last month and a half or so. That is all rolling up into that private credit market. So anyway, so like I said, I don't think the community banks really have too much to worry about. But let's look at a couple of these industry numbers here real quick. I'm just gonna make this a little bit bigger so everybody can see it. So let's look at this. So efficiency ratio, again, 2025, hovering around 61%, 62%. Not too bad, perfectly fine. Net interest margin for 2025. Hanging at about 3.62%. Again, great, no issue there. But basically, what you're looking for there is a number of 3%. You want to see at least 3%. 3.62 is a really solid number. If you hit 4, that would be like, man, things are really going well. They're really making money. But 3.62 is really good. Nothing wrong with that. Return on assets, ROAA, 1.19%. That's perfectly fine. That's a really solid number. Again, what you're looking for there is at least 1%. So anything over 1, great number. Return on asset equity, or could be considered return on equity, 11.35%. Again, great number there. What you're looking for there is a number of at least 10%. So 10% or higher, doing really great. It's 11.35. That's great. Year over year earnings change is up 12.6%. Fantastic. So I mean, overall, these banking industry aggregate profitability metrics are really good. I mean, all these numbers are really solid for the industry. Don't really see, don't really see anything wrong there at the moment. But like this headline says here, credit is focused, but holding up despite uncertainty. So obviously, yeah, credit's the big thing. How is credit going to, how's credit going to be over the next few months? So, but we'll see. We'll come back to that. Okay. Getting in now to the government shutdown. So Trump signs the bill on Wednesday night. He ends the government shutdown. So President Trump has ended the longest U.S. government shutdown in history, signing a funding bill passed by both chambers of Congress. The House shutdown vote was 222 members saying yay and 209 members saying nay. We all know is pretty much strictly on party lines. Federal workers were told to report back to their jobs on Thursday. So back to work they have gone. Government shutdown is over. It was, I believe, over 40 days. So it was the longest shutdown. So let's see, 43 days. It was 43 days in total. Longest shutdown in U.S. history. But here's the key thing to understand. They solved nothing. They solved absolutely nothing. They kicked the can down the road until January 31st, basically. So come another couple months from now, we're gonna be right back. Probably right. We might have another shutdown in come February of next year. So, but okay, here's a key question here with this though. So the shutdown's over. So when's the economic data going to return? Now, I love, as everybody knows, anybody who's been watching for a while, I love giving all you guys the economic indicators. And obviously hadn't had anything to report here for the last month and a half. It's not a whole lot's coming out. But the government's statistical agencies are getting to work producing key economic reports that were delayed by the government shutdown that ended on Wednesday. Forecasters expect a few reports from September to be released in a matter of days, while others could be delayed for weeks. Another key question is whether reports from October will ever be released. So the government's data dark age is coming to an end, but it might take some time for the government statistical agencies to catch up to their regular schedule. Washington is getting back to work after having been shut down for a record 43 days, and the Bureau of Labor Statistics, the Bureau of Economic Analysis, the Census Bureau, and other agencies can now start to play catch up. So based on past government shutdowns, experts believe that certain long delayed economic reports will be released in a matter of days. Others might take weeks to compile, and some may never be released at all. So investors, policymakers, and business leaders are especially anxious to see data on inflation and the job market, since recent reports have flashed some warning signs. The most recent government reports showed the job market slowing down and inflation heating up. That poses a dilemma for officials at the Federal Reserve, who must decide whether to lower borrowing costs to boost hiring or keep rates higher to fight inflation. So my guess on this is that this is going to lag a little bit here over the next month, because obviously one of the big issues is in 2 weeks we have Thanksgiving coming up. So obviously a lot of, even though you had the shutdown, a lot of people in the government still going to be on vacation. So that's going to further slow down getting some of this stuff out, the holidays here. So my guess is we'll probably get a couple of things this week, and I'll share what stuff is due to come out this week a little bit later on. But my guess is we'll probably get a few more things this week coming up, and then we're going to take another lull, and then probably the first 2 or 3 weeks in December, we'll probably get a number of reports will probably be coming out fast and furious for a couple of weeks. Some of the things are relatively easy. They could get some of these things, they can pull the stuff together real quick. Some of them take a little bit longer. So we'll have to see here. And my guess is it won't really be until January, till after we get back, after the new year, after the holidays, that a lot of these economic indicators and economic reports will finally start to get caught up. Now, there is some question, like, are we ever going to get are we ever going to get what was I going to say here for a second? I lost my train of thought for a second. Are we ever going to get October numbers? So yes, I would think yes, that we will, but it just might take a couple of months. Like, in other words, what they might do is they might release like the numbers for November and the numbers for December. But then when we get to like January, we might get to a point where they might say, hey, you know what? We were finally able to go back and put it together. It's sent out. We're going to release. Because again, they're constantly making revisions to the numbers. Numbers get revised up. They get revised down. So my guess is a couple months down the road, as you begin to get to revisions, they will eventually put it out and it will get put out there. But for all these people out there like, oh, we're never going to get these numbers. Yeah, no, I don't think so. I think we absolutely will get the numbers. It just might take a little while to get there. Now, what I'm going to get to here in just a second is the Federal Reserve, the interest rate decision for December. Like, what this leads to a big question. Like, if they don't have the economic data here, in the next month, how does that impact their decision for December? Will they cut rates? Will they not cut rates because they don't feel like they have the necessary data in front of them? Maybe. Well, maybe hold that thought for just a second. So, okay. Now, the Fed. So what did the Fed do here during the shutdown? So the Fed turned to these data sets during the shutdown, and here's what they revealed about the economy. So officials at the Federal Reserve are missing critical data during the government shutdown, relying instead on reports from private companies. There are indications that hiring continued to slow since the government's most recent report in August. Private sector inflation data was mixed, and one index rising to a 2-year high and another showing prices falling. So again, so it's kind of some interesting data, but let's see here. State level initial jobless claims. So although the Department of Labor is not publishing its usual weekly report on jobless claims, analysts at Goldman Sachs and JP Morgan were able to piece together an estimate based on reporting from states. So according to that estimate, 219,000 people filed for unemployment last week, down from 232,000 the week before. Job openings from Indeed. Powell said he was looking at private data on job openings on sites including Indeed, which similarly signaled a slowdown in the job market. ADP pay data. So payroll provider ADP publishes reports on both job gains and losses in the private sector as well as worker pay. ADP's data, not so reliable. as I've pointed out in months past, they have known to be kind of way off at times in some of their reporting. Price stats. So Powell said private data provider Price Stats supplies a look at inflation in the absence of official data, such as the personal consumption expenditures report from the Bureau of Economic Analysis. Adobe. Software company Adobe also publishes a price index based on data from online retailers. Online prices actually fell 2.9% over the year in October, according to Adobe. The Beige Book. Powell shouted out the Fed's own Beige Book is an important, if anecdotal, source of economic data. The Beige Book compiles reports from the Fed branches all over the country. In October, the report showed the job market losing steam in its low hiring, low firing limbo. So again, that just kind of shows out these were some of the different data sources that the Fed has been using here over the last 45 days. Pointing to certain things. Are they very conclusive? No, not at all. But again, some, at least I would describe these as half decent alternatives in terms of data sources for them. So, but again, I just wanted to point that out that again, the Fed. So as we get into this question of, will the Fed or won't the Fed cut interest rates based on the data that they don't have? Well, they do have data, and they have been able to glean data from these different data sources. So again, they're not, I would describe it, there's somewhat of a dearth of data out there, but they're not without data. They have gotten data from these other sources. So they are able to look at and make determinations based on what's going on. Therefore, I believe that if they wanted to cut rates, that they would still be able to do so. So like I said, I point that out there. So now, one other thing here on the government shutdown that I just wanted to point out. So the SBA loan backlog awaits as shutdown ends. So here's what businesses need to know. So the Small Business Administration resumed lending after 43-day government shutdown ended. Experts expect 3 to 4 weeks for SBA to clear its loan backlog. Preferred lenders are already processing applications. So the Small Business Administration is making small business loans once more after President Trump signed the bill ending the shutdown. The legislation that ended the record 43-day shutdown will fund much of the government through January 30th, with some provisions, including food stamp benefits, funded through the end of fiscal 2026. The deal also provides for the rehiring of federal workers. Let's see here, blah, 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 blah. But the end of the shutdown also leaves a number of unanswered questions, including the future of the Federal Aviation Administration's previously announced flight cuts, whatever, but the impact on the SBA. So days just before the October 1st shutdown, the SBA said it was on track to close fiscal 2025 with a record amount of capital delivered to its businesses, with 84,400 7A and 504 loans approved for a total of $4.8 billion in loans. The agency said it guarantees 1,600 small business loans per week worth more than $860 million, or 320 loans per workday for $170 million. Now, the SBA will have to tackle all of its pending loans. So based on experience going through a government shutdown, it will take SBA 3 to 4 weeks to work through the backlog. So first up will be the loans sitting at the agency's processing centers, including any residual loan applications and loan modification requests that require U.S. Customs and Immigration Services compliance checks. Then the SBA will start working through applications in the order in which they were received. So again, here, just SBA working through their backlog, probably going to take about 3 or 4 weeks to get there, but just something that people need to know, because I'm sure there are obviously a lot of people out there probably have been patiently waiting to get their SBA loan done here for the last month and a half. So just something to point out. So now, okay, coming back to the Fed here now. So the Fed is increasingly torn over a December rate cut. So as data went dark, inflation hawks push to pause rate cuts as a contentious October meeting. The divide might not end soon. Yes, I would expect it not. So an emerging split within the central bank complicates future monetary policy, with officials divided on persistent inflation versus a sluggish labor market. The path for interest rate cuts has been clouded by an emerging split within the central bank, with little precedent during the Federal Reserve Chair Jeremy Powell's nearly 8-year tenure. Officials are fractured over which poses the greater threat, the persistent inflation or a sluggish labor market. And even a resumption of official economic data may not bridge the differences. Now, I want to say a couple things here real quick. Number one, the Fed, as per their own projections, these are their own projections, nobody else's, the Fed's projections, has basically pointed out that inflation has reached its top. Okay, we are at the top right now for inflation. We're hovering around 2.93%. This is the top. They've as per their own projections, beginning in January, the inflation is going to begin to come back down. The inflation is going to start to come back down, and it's going to continue down throughout 2026 and into 2027, where it will eventually work its way back down to the Fed's 2% target. So, if that is where the Fed's own projections have things going, what are they so concerned about with inflation overall? This is the question I keep asking, as per, again, just looking at their own projections. Now, the labor market, on the other hand, is really in dire straits at the moment. The labor market is not looking very good. We definitely have a lot of underlying issues there. And again, I have advocated for the rate cuts, saying, we need to have more rate cuts here to help to prop up this labor market. Now, one of the thing I would point out here on this is that, Jeremy Powell was very emphatic at the end of the last Federal Reserve meeting, where he basically flat out said there's not going to be, any more rate cuts. Like I gave you a couple rate cuts and I'm done. And that was his opinion. That was his, from his lips to God's ears. And I think that I think Jeremy has been a super curmudgeon here for this entire year, and he has just been a stick in the mud. And his whole job, as I've been saying for months and months and months, has been simply to we're going to resist Trump. We're going to resist Trump. We're not going to get involved in all this nonsense. Blah blah blah. We're not going to decrease the interest rates. We're not going to do anything to help him out. Again, one of the things I've said, the Fed has many tools in their toolbox, and there's a lot of things that they could have done to help this situation, which they have just totally not done. So yes, while they stopped increasing rates and they started to cut interest rates at the end of 2024, they also kept the reduction of their balance sheet going, which was a form of quantitative tightening. That was not helping things. Okay, that was not helping things. Yeah, it helped Jeremy Powell in his legacy, because that's the only reason he was reducing the balance sheet of the Fed, was because he was worried about his legacy, not the balance sheet of the Fed and not the American people. All he wanted to do was, when he writes his memoirs in a year from now, he just wants to be able to say that, hey, look at the job I did. After the pandemic, the Fed's balance sheet went up to $9 trillion. And I was responsible. I brought that back down to 6.7 trillion. I did that. I tried to do my best to fix the Fed's balance sheet. That's all he wanted to be able to say. He just wanted to be able to say that. Now he doesn't take it the step further to basically say that, when Trump was trying to fix the economy when he came in, I basically totally shafted him and the American people by doing that for 10 months longer than I should have. No, he's not going to say that. He's not going to say that he drained all the liquidity out of the system, and he could potentially be causing a crisis now in the repo market. He's not going to say that. He's not going to talk about that. He's not going to talk about the fact that the labor market is going into the toilet, and he's not reducing interest rates to tackle that. He's not going to say that. He's going to put this face on that, everything that he did was prudent. It was prudent and it was right, and he took the necessary steps, and yada yada yada, blah blah blah. But I am taking Jeremy Powell for a man of his word. When he says that he was not going to cut interest rates, I believe him. I believe him when he said that. And I do not think there's going to be an interest rate cut in December. Do I think there should be a rate cut? Yes, absolutely. But is there going to be a rate cut at the end of the day? No, I don't. I don't think so. Um, but let's move on to some other things here. So Atlanta Fed President Bostic says that he is going to leave his position when his term expires in February. So Atlanta Federal Reserve President Raphael Bostic said Wednesday he will be leaving his position when his term expires in February of 2026. The announcement comes ahead of a pivotal year for the Fed and its rate-setting body, the FOMC. Bostic's term has not been without controversy. In October of 2022, the Fed announced it was looking to trades Bostic made during blackout periods near policy meetings. He ultimately apologized for discrepancies. Yeah, that was all the insider trading, if everybody remembers, as another one of the Fed's greatest hits. Yes, that was all the insider trading they all got busted for, including Jeremy Powell, I might add, including Jeremy Powell. And two Fed presidents, the Fed president in Boston and the Fed president in Dallas, both had to resign over that. And which was very interesting, as I pointed out with the whole Lisa Cook fiasco, is, with her mortgage fraud and all the other nonsense going on there. But, those two Fed presidents, they resigned immediately at the first sign of impropriety on their parts. They resigned immediately. Now, I think they had to resign. I think they had to be the sacrificial lambs in that specific incident, because they didn't want to open up the gates on perhaps a lot more people at the Fed. So they fell on the sword and basically said, no, we did this. We're resigning. We're going away. So it's interesting that they did that. But then when Lisa Cook got hit here, she basically was like, no, I'm staying. I'm going to fight this thing out. I'm not going to go down without a fight. I will hang here until the bitter end. But now the Supreme Court is hearing, or is looking at, I should say, that lawsuit, that argument, if you will, about whether President Trump has the ability to fire Lisa Cook as a Fed governor. So, and we shall see. That I'm assuming that the decision on that is probably going to be out in January. But Stephen Miran was only elected to the Fed board for a few months, and then his term is up, I believe, at the end of the year. I believe December 31st, his term is up. We'll see what happens with Lisa Cook. And now you got the Fed's Bostic is going to leave at the end of February. Jeremy Powell is done in May of next year. So we are going to see some turnover here in the Fed and with these Fed board governors. So it will be interesting here. Trump, I believe that the Federal Reserve is going to see a lot of reform. I do believe that President Trump is I have a feeling he is going to win that court case at the Supreme Court, and the Supreme Court is going to say that yes, as the president, as the head of the executive arm of the U.S. government, he does have the right to fire Lisa Cook. I do believe that. Now, people in Congress, again, because the Fed loves to hide behind their independence shield. Now, they'll probably run back and cry foul and say, oh, no, Trump is destroying the independence of the Fed and all this other stuff, whatever. Well, I have said here, that my argument on that has always been that I don't care who it is. Like, I don't care if it's a Republican president or a Democratic president. I believe that all of these people are under the power of the president. They serve at the pleasure of the president. And if the president wants to get rid of them, the president has the authority to get rid of them. Okay. They work for the executive. Now, if the Fed feels like it doesn't want to be under the executive, then I would say the Fed really needs to make its mind up about what it is and what it isn't. Is it part of the federal government or isn't it part of the federal government? And I don't buy into this argument. I never have of, oh, well, the Fed's part of the federal government. They get to borrow billions and billions of dollars to build their Taj Mahal office and do whatever they feel like, whenever they feel like it, not get audited. You don't get to do that and then run back. And when we say, well, wait a minute, you're part of the federal government, and then sit there and say, oh no, wait, we're independent. We're independent. We could do whatever we want, no, I don't believe you could do whatever you want. I don't believe that you're independent. I believe that argument, I think that is an argument that is long overdue. I really do believe that it's time to break open the book on the Federal Reserve Act, and I think it's time to go back and start making some changes. I really do, and I think you need to start with the fact that you need to solidify beyond whatever the Supreme Court's decision here. If they decide that President Trump could fire Lisa Cook, that's great. But I think that Congress needs to go back, and I think they do need to make some amendments to that Federal Reserve Act. And I do think they need to make it clear that the President of the United States does have the authority and does have the power to fire the head of the Federal Reserve Bank and any Fed governor that is caught with their hand in the cookie jar. If they're caught doing something bad, he should have the ability to fire them. Period. End of story. Just as he would anyone else. And and people could disagree with me. They could feel free to comment on that. That's just how I feel about it. I have never, like, a lot of things with the Federal Reserve have just never sat well with me. Again, I don't like this idea of the independence of being unaudited, being able to just do whatever they want to do whenever they want to do it. I do not believe that was ever the real intention when the Federal Reserve was created in 1913. But who am I? What do I know, right? I'm just some YouTuber that sits here and spouts off on Saturday nights. All right, let's hear it. All right, so Mirren, like I said, speak of the devil and he shall appear. Stephen Mirren says a half-point cut appropriate for December, but the Fed should at least reduce by a quarter point. So the Federal Reserve Governor Stephen Mirren on Monday advocated for further interest rate cuts as a way to stave off a potential economic softening ahead. In a CNBC interview, the central bank official held to his belief that the Fed should be moving at an even more rapid pace than its traditional quarter percentage point reductions. He advocated, as he has at the previous two Federal Open Markets Committee meetings, for a 50 basis point cut or half percentage point reduction, though he said there should at least be a quarter point easing. So nothing is certain. We could get data that would make me change my mind before then and now, Mirren said, but failing new information that's made me update my forecast looking out in time, yeah, I would think that 50 is appropriate, as I have in the past, but at a minimum 25 basis points. So we'll see. Like I said, my gut is telling me Jeremy Powell is not going to do anything. He's going to continue to anger people like Stephen Mirren and some of the other Fed governors, perhaps Mickey Bowman. And you're going to continue to have this now divided Fed board of governors. You're going to continue to have this divided Fed board, and we'll have to see what happens there with them. But again, like I said, I'm betting right now that there's not going to be an interest rate reduction in December. We will have to wait to see what happens. My guess is that Jeremy Powell, when he doesn't cut rates, is going to take a beating. He's going to take a beating. First, he's going to get hit with Trump. The tweets are going to start instantly after that meeting. And then there are going to be dissenting votes from a number of Fed governors. I think maybe possibly the highest number of dissenting votes we have seen in quite some time. Might be as high as 4 or maybe even 5 dissenting votes by him not wanting to cut rates. And like I said, and then he's going to get blasted in the media, because the business media is actually going to be all up him, because I believe that as the updated labor market numbers continue to come out here over the next couple of months, you are going to continue to see a weakening of the labor market. And I'm going to show you a couple articles on that a little bit later on, and you'll see exactly what I'm talking about. I mean, Verizon announcing that I think they're going to lay off 13 or 15,000 employees, on top of a large number of other companies already saying that they're going to lay, X number of employees off. So you are seeing a lot of companies beginning to cut back and making these labor market cuts. So like I said, that's kind of how I see things playing out here over the next few months, but we shall see. Okay. Interesting story here. I talked about this a little bit, I would say, over the last 6, maybe 7, 8 months. So, if everyone will recall, if I had to remember, if I am remembering correctly, and if I am saying this right, so if everyone remembers, Elon Musk basically had got blasted by a judge down in Delaware because Tesla was registered, incorporated. Their corporate headquarters were in Delaware, as does thousands of other companies around the United States. Now, Elon Musk went in to get his pay package increased, and basically these judges in Delaware stepped in and said, "Nope, can't have it. We're not going to allow it. Not going to do this. Not going to do that." And I thought it was a really, really stupid thing. I thought it was clearly a political decision, clearly a political move. But I thought it was a move. It was a stupid move with very long-lasting and far-ranging consequences. I said, you are now going to see a lot of companies roll out of Delaware because they're just, you add that uncertainty, you add that, they added this wild card element that basically, yeah, if you do something that, some judges or some judge in Delaware doesn't like, yeah, they're going to cause you a lot of problems. And that has been, I think, very unsettling for a lot of companies that incorporate and have their headquarters in Delaware. So, and here's a perfect example right here. Coinbase moves incorporation to Texas from Delaware following Musk's lead. So Coinbase chief legal officer Paul Grewal wrote in a Wall Street Journal op-ed that the crypto platform is moving its state of incorporation to Texas from Delaware. Elon Musk has led the campaign to exit Delaware, reincorporating Tesla and SpaceX in Texas. Like Musk, Coinbase CEO Brian Armstrong was a major supporter of Donald Trump's 2024 campaign for president. So Coinbase is following Tesla out of Delaware and into Texas. Delaware's legal framework once provided companies with consistency, but no more. Grawl wrote, pointing to recent unpredictable outcomes in the Delaware Chancellery Court. A handful of notable names, including Dropbox, TripAdvisor, and venture firm Andreessen Horowitz, have announced departures from Delaware. It's a move that was championed by Musk following a Delaware Chancery Court ruling that ordered Tesla to rescind the CEO's 2018 pay package, worth about $56 billion in options. If your company is still incorporated in Delaware, I recommend moving to another state as soon as possible. Musk wrote in a post on X in February of 2024 when he filed to change SpaceX's incorporation's state. So, but then, not to be outdone, Delaware ran right out and basically said, hey, despite the Coinbase departure, only 28 companies have left Delaware this year. So Coinbase this week became the latest high-profile company to announce plans to leave Delaware and incorporate elsewhere. While Elon Musk and a select few others have been vocal about exiting Delaware, they remain distinctly in the minority. Only 28 companies have de-incorporated from Delaware this year, while almost 250,000 new entities had been formed in the state as of the end of September, according to the Secretary of State's office. So yes, I know that Delaware was very quick to put this rebuttal out there to basically say, hey, we don't want this to show as like a pattern. Everything's cool here. We could keep going with this. Despite this, they can put out all of the articles they want to, and they can basically say, oh, only a few companies have left. It's not that big a deal, whatever. I just have to believe that, the damage is done. The horses are already out of the barn. Like, you're not going to put them back in the barn at this point. And I just feel that what you're going to see is, over time, you are going to see a trend of a lot more companies basically looking to other states other than Delaware to do their incorporations and to house their headquarters. And again, to be fair, a lot of these companies are not small businesses. These are huge companies. These are multi-billion-dollar enterprises, S&P 500 companies, the largest banks in the country, you name it. These are not small businesses. So, you could see a lot of big businesses rolling out. And I like I said, I just believe that trend is going to continue because of what they did. Because I just think it was a very, at the end of the day, what you have to ask yourself is okay, this, this judge, this judge squashed, his, what does it say here? Where does it say about the pay package? Yeah. So the Delaware Chancery Court ruling that ordered Tesla to rescind the CEO's 2018 pay package worth about $56 billion. Now, I would say, like, did that really make a difference? Because I got this right here. Tesla shareholders approve Elon Musk's $1 trillion pay package, not a $56 billion package, a $1 trillion pay package. And more than 75% of votes cast in support of Musk's record-setting package. Is mind-boggling. A $1 trillion pay package. So is what they did, did it make any difference? No, it did not make any difference. It made zero difference, but at the same time, it made zero difference, but it completely undermined a lot of companies' faith in the system there in Delaware. And, so again, it accomplished nothing. I just think it was very stupid. And I think you will, continue to see this trend roll forward. Now, a couple other things came out this week. Now, Donald Trump promised a $2,000 tariff dividend, but the check isn't in the mail yet. Yes. Excuse me. So the dividend check is not yet in the mail. Basically, and I saw something this morning that basically said that dividend check will probably not arrive, if it does at all, until probably January or February of next year. It's definitely not going to get here by the holidays. Now, I will say, for whatever my 2 cents are worth, I would basically say I don't want a $2,000 check. I don't want it, because if everybody remembers, the last time we got a $2,000 check from the government was during the Biden administration. And you know what happened at the end of that check? They said, oh, by the way, we're going to tax you. Yes, we're going to tax you on that check. Which was ridiculous, because I look at it like, if you're going to give it back, just give it back. Like, why so you're going to give it back, but I got to pay taxes on it? And in that case, I actually basically I put it aside. I basically was like, yeah, I'm not gonna be, or I think I got the money and I didn't do anything with it. I didn't spend it. I basically put that money aside and basically just paid it back to taxes at the end of the year, because it was so stupid. And this, again, I would really rather see them take this money and put it toward paying down the national debt. Like, you see, we got this little $38 trillion in national debt here. I would really, that money could really chip away at the U.S. federal budget deficit, as like that. And that's what I was really wanting that money to do, not to basically hand out $2,000 checks to everybody. And again, the $2,000 check is not going to go to everybody. It's going to go to, people. Let's see here. Trump proposed the new payments to low and middle income Americans in a weekend post on social media. Some experts, however, have questioned the math behind the idea, yada, yada, yada. But again, the key language there, to low and middle income Americans. It's not going to everybody. And, and again, and I kind of sit there, and that to me leads to another issue. Like what is, there's all this talk out there from so many people about fair and equitable. Oh, everything's got to be fair and equitable. Well, this to me is not fair and equitable. If you're going to give $2,000 back, you need to give it back to everybody. I don't care how much or how little somebody makes. If the government's giving it back, you give it back to everybody. Why? Okay, so they get everybody gets $2,000, but because I go to work every day and work my butt off and pay taxes, I don't get that $2,000 check. That's it's not really fair. If your shtick is fair and equitable, gotta say I don't really see that as fair and equitable. But I really, but like I said, for my take, I just don't like this. I just don't like it. I want them to take that money and pay down that national debt. Try to get that federal budget deficit back to break even. That's my take on it. So okay. This is actually, I think this was big news this week, and I think this is actually bigger news than a lot of people really think. So Visa and MasterCard near deal with merchants that would change the rewards landscape. So deal under discussion would lower credit card interchange fees for merchants, but could make it harder for consumers to use reward cards at the register. So Visa and MasterCard are nearing a settlement with merchants that aims to end a 20-year-old legal dispute by lowering fees stores pay and giving them more power to reject certain credit cards, according to people familiar with the matter. Now, I will say that the suit was settled. It was, in fact, settled, so it's done. This article came out probably about a day before they reached the settlement, so it is settled and they're finished. So under the terms being discussed, Visa and MasterCard would lower credit card interchange fees, which are often between 2 and 2.5% by an average of around 0.1 percentage points over several years, the people said. They would also loosen rules that require merchants that accept one of the network's credit cards to accept all of them. A deal could be announced soon, the people said, and would require court approval to take effect. If an agreement is finalized, consumers could see big changes at the register. Merchants that accept one kind of Visa credit card wouldn't have to accept all Visa credit cards. For example, under the current talks, credit card acceptance would be divided into several categories, including rewards credit cards, and no rewards programs, and commercial cards. The people familiar with the matter said some stores might turn away rewards cards, which charge them higher fees and in recent years have become very popular with consumers. But stores that reject those cards would face the risk of declining sales. The case dates back to 2005 when merchants sued Visa, MasterCard, and large banks, alleging that they engaged in anti-competitive behavior with interchange fees and acceptance terms. No, no. They wouldn't have done that. I cannot believe. No way. No way would they have done that. Nope. Yeah. Yeah, I just can't see it. Can't see it. Yeah, of course they did that. Yeah. In March 2024, the two sides reached a deal to lower interchange fees by around 0.7 percentage points on an average over 5 years. The arrangement would have created a little more flexibility for merchants that want to charge consumers extra when they pay by credit card, a practice known as surcharging. The judge overseeing the case rejected the deal. The new settlement being discussed also would involve surcharging, the people said. One of the challenges in the case is the divide between attorneys for different factions among the merchants. The lawyers chosen by a judge to represent the merchant class group haven't been on the same page in the past as lawyers representing big merchants and trade groups. But yet they got it resolved. They got the thing resolved. It's all done now. Now, yeah, again, you could see some of these changes. I think perhaps some of the more common things you might see are, stores probably, like not accepting American Express because I believe American Express charges the highest fee. Again, not accepting some rewards cards because their fees are more expensive than others. And again, they talk about like, oh, well, the sales, they could really see this massive decline in sales. No, they won't. No, they won't, because most people, the average person has about three. I believe the average person has at least 3 credit cards, maybe even more than that. And again, okay, if you got your credit cards and you're like, oh, I can't use my rewards card. Okay, I guess I have to go to my regular Visa or my regular MasterCard. It's not. Yeah, I really don't think it's gonna like hurt all these retailers that decide not to accept the rewards cards because they have to pay the higher fees. Merchants. I think it's a love-hate relationship. I think that there are merchants out there that love the credit cards because it just makes tallying and keeping the books and all that stuff. I think it makes it a lot easier. I think that there are some merchants out there that would still love to deal in a lot more cash for obvious reasons. But at the same time, the thing that kills a lot of these merchants is that they have to pay a ton of money. It's great having electronic payment. It's great having these credit cards and the debit cards and everything else. But it does cost the retailers and the merchants a lot of money. Costs them a lot of money to pay all these credit card fees every year. If you're just operating a simple online website and you have to pay those fees, they're not cheap. Those fees are not cheap. So again, I'm sure there's a lot of retailers, a lot of merchants out there that are really welcoming this. And again, I think that this is going to become a bigger thing than perhaps a lot of people realize. A lot of people probably weren't aware of this. Like when they saw this week, they were probably like, "Oh, that's, what's that? Probably nothing big. No big deal there." As I said, yeah, Tesla approved this $1 trillion pay package for Elon, which is absolutely nuts, but they did it. Okay, I guess he wants to become the first $1 trillion man. He is all about those microchips, baby. The computer, the robots, and the microchips. That's what he wants. He wants a Tesla microchip in what. He wants it in your hiney, and he wants it in every hiney in America. Yeah, not gonna get mine. Not gonna get mine. No one's ever getting mine. Okay. Chips held hostage in trade wars start flowing again to auto suppliers. Chinese export restrictions on Nexperia's semiconductors pose big threat to car production. Now, if anybody had looked at, I put out a strategy room bonus episode a couple of weeks ago where I did a whole update on the auto, of what was going on with the auto industry. I also did an auto industry update episode, and so I talked about this a lot, about basically how you had this company Nexperia that I think was in, were they in like the Netherlands? I'm trying to think where they were at. Yeah, they were in the Netherlands. And this company basically, makes a lot of, not sophisticated microchips, but they make a lot of microchips for the auto industry. But the Chinese, the CCP, had taken ownership control of this company, and basically they came out, and the Netherlands government came back and basically said, no, we're not gonna let the CCP basically take control of this company and dictate what's going on. And then as part of the kind of U.S. trade negotiations that went on, the U.S. basically said, yo, we have to stop this because you're really going to hurt our auto industry. We need to get production of these auto chips back out there. And so they basically got this rolling again. So I saw this article, and I just wanted to provide this as an update, just to say, hey, yeah, this is good news. This is back up and rolling again. And hopefully that will help ease this burden on a lot of the auto industry out there, and this won't become a major problem. So, but we'll see. Keep an eye on it. Okay, what do I got here? Okay, very interesting stuff here. I do have some Epstein news here. Now, again, some of you out there might be saying, well, wait a minute, Joe, this is Epstein stuff. This is like political stuff. This is not, what does this have to do with banking? I'm going to show you what this has to do with banks. This has to do with actually a number of banks. This is not going to be a good thing for a number of banks out there. So Trump to ask DOJ to probe Jeffrey Epstein involvement with Clinton, JP Morgan, and Summers, as in Larry Summers. So President Donald Trump says he's asking the Department of Justice to investigate relationships between his former longtime friend, Jeffrey Epstein, and others. Longtime friend. Yeah, I hardly think so. Trump named former President Bill Clinton, JP Morgan Chase, ex-Treasury Secretary Larry Summers, and Reid Hoffman as people he wants the DOJ to probe for their dealings with Epstein. In a 2018 email released this week by a House committee, Epstein refers to former personal lawyer Michael Cohen pleading guilty charges related to hush money payments on behalf of Trump, and writes, "I know how dirty the Donald is." Yeah, okay, I'm just going to dismiss that on its face because it's not, that part of it is nonsense. But these other cast of characters in here are not so much. A lot of people here on this list need to answer a lot of questions about what they were doing down there on the little Epstein Island, Little St. James, what was going on there. I believe that this was one of the largest blackmail operations that we've ever seen. The real question lies in was, what were these people being blackmailed for? Was it just simply power? Was it influence? Were there other things afoot? We may never know the answer to those questions, but This is going to lead back to other banks. So let's see. Here's an article from Banking Dive. So B of A and BNY blast threadbare allegations in Epstein victim suit. So Bank of America said it's not reasonably foreseeable that red payments made through an account with the bank would set in motion harms to the plaintiffs. BNY called the allegations razor thin. Now, this has to do with a different lawsuit. So Bank of America and BNY each filed motions Thursday to dismiss lawsuits filed against them last month by an alleged victim of disgraced financier and late sex offender Jeffrey Epstein. Bank of America called Jane Doe's suits threadbare and meritless, arguing that the plaintiff seeks to hold the bank liable based on nothing more than allegations that it provided routine services to customers who, at the time, had no known connection to Epstein's sex trafficking. Doe alleges Epstein's trafficking operation wouldn't have existed without banks providing special treatment to him and his co-conspirators. In her lawsuit, Doe said she opened an account at Bank of America in May of 2013 at the direction of Epstein's then accountant, Richard Kahn, whom she said transferred about $14,000 into the account. Kahn regularly sent Doe money for rent through the account, she said. Money in the account was also used to defraud immigration officials, according to the lawsuit. But transactions for those purposes would not have raised red flags the way that large cash withdrawals would have, Bank of America argued Thursday to the U.S. District Court for the Southern District of New York. So, forgetting the merits of this case for just a second, whether or not these allegations are true or not true or whatever. My point here, the reason why I'm showing you these articles is just to point out that yes, these banks do bear some liability. What the level of liability is unsure, but these banks do bear some liability in this, and they are not going to escape this scot-free. They are going to continue to get mired here with lawsuits, with bad press, with articles like this. And here is another one I'm going to show you here. Goldman Sachs stands by top lawyer Kathy Rumler after her emails with Jeffrey Epstein were exposed. So Goldman Sachs supported its general counsel, Kathy Rumler, after her emails with sex offender Jeffrey Epstein from years ago were released by a congressional committee. In the emails, Epstein and Rumler discuss President Donald Trump, former President Bill Clinton, and Facebook founder Mark Zuckerberg. Kathy is an exceptional general counsel, and we benefit from her judgment every day, a Goldman Sachs spokesperson said. They benefit from her judgment every day. It's a very interesting statement. I think that Kathy here is toast. I think she's toast. And while Goldman Sachs may be singing this tune right this minute, I believe that this is going to change very quickly. Why do I say that? Well, here is the problem for her. She had these conversations with Epstein in 2018, about a year before he was arrested, about a year before he died from apparent suicide in prison. Now you might say, well, why is that an issue? Well, let's rewind for a second. Jeffrey Epstein was convicted in 2008, 10 years prior to this. So as of 2008, everybody knew that Jeffrey Epstein had this sex trafficking operation. They knew what we didn't know, perhaps at that point, was to the extent of said operation was. So this had been out there for about a decade, and yet she's still talking with this gentleman. She's still, she's doing business with them. Like, what's going on here? And and to sit there and to say that she should have known better, like, yes, yeah, and to say that to make a statement where you say like, oh, well, she has exceptional judgment, and she basically provides that exceptional judgment every day. Well, no, I would highly question that statement, because she does not appear to show highly exceptional judgment. She appears to exude a high level of bad judgment, as per all these emails. And so this is going to continue to run out. We got a treasure trove of Jeffrey Epstein emails and information came out here in just the last couple of days, pointing a lot of things at a lot of different people. And the reason, again, I wanted to show these articles here was just to show that this is going to have a ramification on the banking business. This is going to have a ramification. We've already seen here. We got Goldman Sachs, we got Bank of America, we got BNY Mellon, some very large players and banks in the banking space are getting nailed with this. Whether, like I said, whether the allegations are true or not, it's still going to hit them with bad press. It's still going to cause them problems. That's why I'm pointing this out. That's why I think that this is a problem for the banking business. It's a problem for the banking industry. And the banking industry has been trying to run away from this thing for many years. And it just keeps coming back like a bad nightmare because because a lot of these banks did not come clean years ago. If they had come clean years ago and taken out the trash, so to speak, and gotten rid of the people who were originally involved with this, like this is a bad, I'm sorry, man, on Goldman Sachs' part, this is a bad look. Like this is a bad look on their part. And again, I don't, again, do I want to, how do I want to say this? Like, do I want to be responsible for this poor, woman like losing her job or something? Like, no, not necessarily. But I think that when this comes out, when this comes to light, this just goes to show you the extent of how badly a lot of these banks, look the other way, turn the other cheek. Like this is not good. This is not good at all. And they're going to have to address this. They're going to have to address this. They're going to have to take out the trash, so to speak. They're going to have to get rid of some people. And that's why I said, I think, unfortunately for Kathy here, I think she's going to be toast here in the coming days and weeks, because this is a bad look, man. Bad look. So, all right. Well, enough on that. All right, I tell you what, I'm going to take, before I get into, because I've got a whole bunch of tariff stuff here that I want to get into. The Supreme Court is now hearing this case on the tariffs. The Supreme Court's appearing skeptical of this. But before I get into all this, I want to do what I normally do, and that is I want to talk about the episodes that I put out here over the last couple of weeks. Just talk about things over there. I want to give you guys the economic indicators that hopefully will be coming out this week. We shall see. So, and then I've got banking news that I want to give everybody as well. So let's jump into the economic indicators, shall we? So as of right now, this is what's coming up for this week. So on Monday, November 17th, we get the New York Empire Manufacturing Index. Tuesday, November 18th, we got the industrial production. We get the API weekly crude oil stock. Wednesday, November 19th, we get the building permits, Atlanta Fed GDP now for the fourth quarter, 20-year Treasury bond auction, FOMC meeting minutes at 2 p.m. Thursday, November 20th, we get the Philadelphia Fed Manufacturing Index, existing home sales, 10-year tips auction. And then on Friday, November 21st, the manufacturing PMI, services PMI, Michigan consumer sentiment, and the U.S. Baker Hughes total rig count. So that's the economic indicators coming up for this week. Hopefully, with any luck, we will see. I don't think we'll see all of that, but hopefully we'll begin to see most of that information start rolling out. So, okay, now let me go to the episodes I've had here. Now, since I missed last week, I want to roll back through the episodes I had the week before. So let's go back. 2 weeks here. So as I alluded to a few minutes ago, I did an update on the U.S. auto industry. Now, the U.S. auto industry is currently dealing with a myriad of problems that include a pullback on electric vehicles, tariffs, a fire at aluminum producer Novelis, underwater car trade-ins, concentration of purchasing by the wealthy, subprime delinquency, and microchip issues with a Dutch CCP-controlled company, Nexperia. Some of these issues will be solved faster than others, but the auto industry, just like many other industries, is facing a paradigm shift around tariffs and technology. So that episode reviewed a number of articles from a number of different sources, but a lot of things in the auto industry right now of a lot of concern. So check that out. Then the next I did, what is going on with credit scores? So a war of sorts has broken out between Fair Isaac and three credit reporting bureaus, which are TransUnion, Equifax, and Experian, over pricing and usage of the FICO credit score model. So that episode examined how America's overall credit scores are performing, how rental payments can be used to improve consumer credit scores, effectively kind of like alternative data, and the effects on consumers of the FICO dispute itself. So again, I thought it was a very interesting episode there on what's going on with credit scores. Then from there, I went on to no more bank robberies. So according to an FBI report, Bank robberies in the U.S. have declined from a high of approximately 9,500 or 9,500 in 1992 to less than 1,400 in 2023. So why have bank robberies decreased? Well, this episode reviewed an article from Investopedia titled "The Death of the Bank Heist: Where Have All the Bank Robberies Gone?" And the article presented 5 theories. Number one, not enough of a payout. In other words, you can't get that much money when you rob a bank now. Number two, fewer targets, a lot less, less bank branches than there were 30 years ago. Number three, easier to get caught. Security's gotten better. Number four, tougher prison sentences. And then number five, better alternatives, easier targets. So, but again, I thought that was a very interesting episode on the dramatic decrease and the overall number of bank robberies in the United States. Then I went to there's a conversation right now on deposit insurance reform. So the question of this episode was, is deposit insurance being reformed to benefit billionaires? So banking regulators are considering deposit insurance reform to better protect consumers and businesses. Congress is also considering deposit insurance reform through a proposed act titled the Main Street Depositor Protections Act, Senate Bill 2999. The question is, who will the deposit insurance reforms really benefit? Is this reform focused on consumers and businesses or just billionaires? This episode examines an article from the Epoch Times titled Deposit Insurance for Billionaires. So again, I thought that the article that I reviewed and the topic in question, obviously a very timely topic as Congress is debating deposit insurance reform right now. And the big question on there is that who is that reform really benefiting? So again, interesting episode there if you want to check it out. And then I did an interview with Chad Hall, investment banker from Janney. Chad Hall had been on. He had done a previous interview with me, which is kind of like an introductory interview. Chad and I talked about Janney Montgomery Scott, what they do as an investment bank, a lot of different products and services they offered. We talked about Chad's background, that they're just kind of introducing him to the audience kind of thing. This episode where he came back, we just had a more general discussion on the bank M&A market. So Chad Hall, investment banker with Janney Montgomery Scott, returned to discuss the current bank M&A market. Chad and I discussed some of the large bank M&A transactions recently announced. We consider the pickup in M&A activity throughout 2025 and what changes are driving the uptick. Chad provides his thoughts on why the activity could be sustained into 2026. In addition, Chad talks about what regulatory and technological changes will continue to influence banking. So again, I thought it was a great interview with Chad. I appreciate him coming on to do that. And I thought we were really good information there in that interview if you want to go check it out. So, okay, so that was 2 weeks ago. So now this week, what did I have come out this week? So on Monday, I put out, are regulatory exams about to get better for community banks? So the Federal Reserve, the OCC, the FDIC are all working on slimming down exam requirements for community banks. Some of the potential changes include regulatory actions such as matters requiring attention, scrapping any requirements that are not found in law or regulation, increasing the existing threshold from 10 billion to 30 billion, changing what pre-exam documentation is required, and tailoring supervision around risks from a bank's business model. So again, a very timely topic. This is, a lot of the federal regulators, the Federal Reserve, the OCC, the FDIC, all talking about how should community banks be regulated. There's an ongoing conversation around this. So again, I thought this episode was very timely. Then on Tuesday, I put out an episode called Citi Strata Elite Rewards Card Disaster. I saw this article in the Wall Street Journal talking about this new rewards card that Citi had just rolled out and what the customers were going through with this. And I just thought it was interesting. I thought, so Citi just rolls out this new rewards card called the Strata Elite, and they wanted to compete with Amex and with the Chase Bank. Chase has got the Sapphire card. So they wanted to compete with Amex and Chase on this. Unfortunately, the rollout did not go according to plan, as a number of customers were locked out of their accounts and have not been able to utilize the card, much less realize the benefits. This really turned into an interesting scenario because some of the people have been able to get the card turned back on, but not everybody. And it's also affected if they had other accounts with Citibank, it's also affected the other accounts that they had as well. So again, just I thought this was a very interesting. I don't know. At the end of the day, I don't know if Citi maybe they put too big of a carrot out there in terms of the benefits that the rewards customers were going to receive for using the credit card. And maybe they realized that maybe people got these cards and started going hog wild, and all of a sudden they were like, "Oh my gosh, we're going to have to pay out a benefit way bigger than what we had originally anticipated." Maybe something like that happened, and they felt like they had to rein it in. But I mean, just straight up locking people out of their cards and then giving them this huge runaround and opening some of the cards for some people, but not opening for others. I mean, you talk about wanting to make your customers angry. Yes, yeah, without a doubt. So not a good thing, not a good look there for Citi on this Strata Elite card, thing here going on. So check that episode out. And then I thought this was probably the most important episode that I put out the week on Wednesday. So, is selling underwater securities always the best strategy? So, bank investment portfolios were hit hard when the Federal Reserve increased interest rates a few years ago, leading to negative, what's known as AOCI, and unrealized losses in bank bond portfolios. So, should banks sell those underwater securities to reposition their existing investments for positive income? The answer is it depends. So this episode examined an article from Bank Director titled "Selling Bonds at a Steep Loss is Not Always a Good Idea," and an article from the S&P Global titled "Falling Interest Rates Lift Banks' Underwater Bonds Nearer to the Surface." So again, very interesting topic because we have seen a number of banks sell these underwater bonds in order to reposition them to put the bank into a better position. Other banks have elected to hold on to the bonds, knowing that they would eventually, when they reach maturity, they would eventually pay off and actually make the bank some money. Not a lot of money, but a little bit of money. They certainly wouldn't lose money on the bonds if they held them to maturity. So, like I said, it creates this very interesting question around how you should handle the bank's investments, when you should sell, and some reasons for why or why not would you want to do that at this particular moment. So again, I thought it was a great episode. Again, a very timely topic, and something that a lot of people should take a look at. Okay, then on Thursday, I did, does niche lending allow your bank to build better relationships? So many community banks around the US focus on niche lending products to grow their business and build strong relationships with their customers and communities. This episode looks at 3 such banks. First Guarantee Bank focuses on commercial leasing. Bell Bank focuses on nonprofit lending. Georgia Bank Company focuses on ESOP lending. So every community bank should focus on creating a niche for itself. And this episode examined an article from Independent Banker magazine titled "Specialty Lending That Strengthens Communities." So yes, I thought this was actually really good because it gave 3 examples of 3 completely different types of lending: nonprofit lending, ESOP lending, and commercial leasing. 3 totally different types of lending, and all 3 of these banks were able to build niches for themselves in this type of lending. And I think that's really important. I mean, a lot of community banks out there have niches like this. Some banks just focus on real estate. Some banks just want to do residential mortgage lending. Some banks are big on consumer lending. Some banks are big on C&I lending. Some banks, again, there's a lot of different flavors for a lot of different banks out there. But I do think that every community bank out there, they should have a niche. Like, they should have a niche, and they should really work that niche day in and day out. I do think that some banks out there suffer from trying to be all things to all people. They'll never admit that, but that really is what they're doing. So I really do think that this is something that a lot of banks should look at and should think about very deeply and consider. But again, I thought really good episode on a very really good topic. And then finally, yesterday, I had come out, how can bank boards better deal with AI? So how can bank boards properly understand and implement AI? So this episode looks at a blog post from PCBB, which discusses the challenges for bank boards in understanding AI and what they can do to strengthen their skills. In addition, We consider an article from Bank Director, which dives into how bank boards can develop AI algorithms to create fairness, accuracy, and appropriate risk appetite for the bank. So this episode, again, examined this article from Bank Director and a blog post from PCBB. So again, I thought these articles were very good in looking at bank directors, like what kind of AI skills do bank directors currently have, and where do they need to work on? What are some of the ways that they could achieve this? What are some of the things they need to look at? So again, thought there were some really good recommendations in these articles, and really brought put light on what really is a timely topic with bank boards right now. First it was kind of making them digitally savvy, right? Getting your board up to snuff with working with a lot of modern technology. That was kind of the first thing. Then now it's become AI. How up to snuff is your board with AI concepts, ideas, thoughts, programs, things like that. So again, very interesting. So those are the 10 episodes that I put out for this last week. Now I would tell everybody, keep an eye out tomorrow. Tomorrow, maybe around noontime, there might be a strategy room bonus episode coming out. I'm not going to tell you what that is, but there might be a bonus episode tomorrow if you want to go check that out. So, okay, now with that being said, got a whole lot of bank news here for everybody for just a couple. Hang with me for 2 minutes, and we'll get back to the articles here. So let's take a look at some of the things here, though. Mortgage rate flat in latest weekly report. The rate for the 30-year fixed rate mortgage averaged 6.24 this week. Still not bad. Still down from what it's been over the last couple of years. Up from 6.22% last week. The 15-year was averaging 5.49%, down slightly from the 5.5% from last week. Agencies released their 2024 CRA lending data. We'll take a look at that report in just a few minutes here. ICBA urges OCC to reject Stripe's National Trust Bank Charter application. So ICBA urged the OCC to reject Stripe's application for a National Trust Bank charter for a proposed subsidiary, which was called Bridge National Trust Bank. So Bridge's proposed business model, which is centered on using deposit substitute stablecoins to the general public without FDIC insurance or banking regulation, represents a dangerous form of regulatory arbitrage. So again, we'll have to keep an eye on that one to see what happens there. CFPB expands 1071 exemptions in their new proposal. Now, obviously, the 1071 rule was one of my 4 big hot button regulatory topics at the very beginning of the year. And now we're starting to get, they've been working on revamping the 1071, and now here is coming out. So the Consumer Financial Protection Bureau issued an updated 1071 proposed rule that would exempt more community banks and small business loans as advocated by ICBA. Expanded exemptions. The CFPB's new proposed rule to implement 1071 requirements would exempt financial institutions that originate fewer than 1,000 covered small business loans per year, up from the Bureau's previous 100 loan threshold. Exempt more small business loans by defining small businesses as having gross annual revenues of $1 million or less, down from the previous $5 million threshold, and dramatically reduce the data points that covered banks would be required to collect. Not perfect, but better. We'll continue to keep an eye on that one and see what happens. The U.S. Mint has minted their last 1-cent coin, ending penny production. So the U.S. Mint in Philadelphia struck the final circulating 1-cent coin, marking the official end of the penny's 232-year production run as a circulating coin. President Donald Trump in February called for an end to minting pennies given the cost. Though there has not been any formal announcement from the Treasury Department, the penny is not being removed from circulation and remains legal tender. However, I just did an episode on this a few weeks ago. It is going to create an issue for banks, getting change, dealing with the loss of the penny. It's going to cause retailers issues too. Like they're going to have to round up. Like in other words, instead of saying $1.99, you're either going to have to say $2 or you're going to have to go down to probably $1.95. So we'll have to see what happens there with that. Now, there was this crazy story about the very last penny being printed could be worth like $5 million. I don't know if anybody saw that out there in like social media this week, whatever, but again, could be, again, I don't know. I highly doubt that, but we'll, who knows? CFPB proposes amending what's called disparate impact rules. So the the Consumer Financial Protection Bureau proposed amending provisions related to disparate impact rules. They would provide that the Equal Credit Opportunity Act does not authorize disparate impact claims, amend the prohibition on discouraging applicants or prospective applicants to clarify that it prohibits statements of intent to discriminate in violation of ECOA and is not triggered merely by negative consumer impressions. Yeah, I have not been a fan over the years of this whole idea of disparate impact. If you really want to know about that topic, go and Google it. I've never really liked it or cared for it. I really thought that it was a kind of a deranged overreach when it was proposed, but again, one of these things, these political things that really dogs the banking industry, unnecessary, if you ask me. But anyway, like I said, so moving on though, CFPB says it cannot draw funds from the Fed. So the Consumer Financial Protection Bureau said it cannot legally draw funds from the Federal Reserve. So that's interesting. We'll have to see what happens with that. Treasury announces Scam Center Strike Force. So the Treasury Department announced the formation of a Scam Center Strike Force to investigate, disrupt, and prosecute the most egregious Southeast Asian scam centers. That's interesting. FDIC. So CRA exams will occur less frequently for most banks. So the FDIC announced the Community Reinvestment Act evaluations will occur less frequently for most institutions. So I think most institutions were on probably an 18-month cycle. So, but institutions will be examined. It will be on an examination cycle of 66 to 78 months, 54 to 66 months, or 24 to 36 months, depending on their size. So that's good. It's great news. Atlanta Fed examines rounding scenarios without pennies. Like, what did I just say? A new blog post from the Federal Reserve Bank of Atlanta examines possible rounding methods the United States could use when penny production is phased out. So, yep, we'll see about that one. Maybe I might cover that one in an episode. I don't know. We'll see. Tax-exempt credit unions shouldn't access public funds. Letter to the editor. So in a new letter to the editor, ICBA community banker Jeff Dick says the credit unions wanting access to municipal deposits without contributing back to the communities they claim to serve is a bad deal for Virginia. So yes, so we continue to see articles. We continue to see blog posts around this idea of, credit unions getting too big and not paying their fair share of taxes. So, and I don't think that is going to let up anytime soon. So New York Fed, household debt grows and mortgage originations tick up in the third quarter. Services sector economic activity expands in October. Private sector added 42,000 jobs in October. So not the worst thing in the world. ICBA urges the OCC to reject Sony Bank National Trust Bank Charter application. So we already saw Stripe's application, the ICBA wanting to reject it. Now we're seeing Sony Bank. So ICBA urged the OCC to reject Sony Bank's application for a national trust bank charter for a proposed subsidiary, its latest response to the sudden influx of applications from non-bank fintechs. So Sony Bank's applications for its proposed Connectia Trust subsidiary appears designed to receive the benefits of a U.S. bank charter without becoming subject to the full scope of U.S. bank regulations. So yes, we'll have to keep an eye out on that. ICBA's unique call for 1033 community bank exemption makes headlines. So again, just as with the 1071 rule, the 1033 rule, otherwise aka known as the open banking rule, another one of my 4 on the hot button regulations I've been watching all year. So ICBA's unique call for the Consumer Protection Bureau to exempt community banks from its 1033 rule, the big bank's opposition to a community bank exemption, is making news. So American Banker reported that while ICBA called on the CFPB to exempt all community banks with assets of $10 billion and under, other banking groups are actively opposing an ICBA advocated exemption. Large banks are against any exemption for their smaller counterparts, the article said. And just so people know, the American Bankers Association, probably going to catch some grief for this. Yeah, the big banks kind of control the American Bankers Association, so it's not really a surprise that they would say that. But you didn't hear that. You didn't hear that from me. Didn't hear that one from me. ICBA signals support for FHFA strategic plan. So ICBA said it supports U.S. federal housing's plan to focus on safety and soundness of Fannie Mae, Freddie Mac, and the Federal Home Loan Banks, while emphasizing the importance of reducing regulatory burden and maintaining the enterprise's mission to foster a liquid, efficient, resilient, and competitive housing finance system. So yes, so we'll continue to watch that one. In a meeting, the ICBA urged the Fed to rescind the debit interchange proposal. So ICBA and other groups met with the Federal Reserve Governor Stephen Miron and reiterated that the Fed's November 2023 debit interchange proposal should be rescinded. So we'll see. We shall see. Audit finds the CFPB's information security is not effective. Interesting. The Consumer Financial Protection Bureau's Office of the Inspector General released an audit that found the Bureau's information security program is no longer effective. The OIG's report said the maturity level of the CFPB's information security program has decreased since last year, noting the Bureau's authorizations to operate for many systems have not been maintained. Risk acceptance memorandums lack documented analysis of cybersecurity risks, and software is outdated. Is that really that surprising? I mean, like, how many people still work over the CFPB? Not too many. Treasury sanctions North Korean institutions involved in cybercrime. ICB, as a shocker, ICB announces opposition to Coinbase's charter application. So ICBA announced its opposition to Coinbase's application for a national trust bank charter for its subsidiary, Coinbase National Trust Company. So in a national news release, ICBA said the OCC should deny the application or, at a minimum, release for public comment critical details of CNTC's business plan, extend the comment period, and hold a public hearing to provide a meaningful opportunity for scrutiny and feedback. So we had Stripes, we had Sony Bank, and now we got Coinbase, all looking for bank charters, and ICBA opposing all three of them. So ICBA urges Treasury to provide meaningful stablecoin regulation and supervision. So ICBA urged the Treasury Department to provide meaningful regulation and supervision to payment stablecoin issuers and digital asset service providers, and to avoid outcomes that would erode community bank lending in local communities. Yes. ICBA urges the OCC to deny Coinbase's application. We already talked about that. Treasury Secretary to the Senator, it's time to empower community banks. So Treasury Secretary Scott Bessent and Senator Bill Hagerty said empowering community banks to succeed is essential to driving economic growth in America. And then finally, court sides with the Fed to reject master account access from non-bank entities. So the United States Court of Appeals for the 10th Circuit sided with the Federal Reserve, ICBA, and other groups by rejecting Custodia Bank's argument that it should be granted automatic master account access because it holds a state charter. So there you go. I think good news, from that one. So, okay. Oh man, that was a lot. I know, but that was our banking news. This is what happens when I'm not here for 2 weeks, man. This stuff just piles up like real quick. Okay, so I want to show everybody before we get back to the article for the news stories. No, okay, here we go. Okay, I just wanted to show everybody real quick. Here are a couple of little research reports that came out this week. I talked about this one at the beginning of the show. Let me see if I can blow this up so hopefully people can see this a little bit better. So this was the paper that was just put out by the Federal Reserve Bank of San Francisco. And this is called What is a Tariff Shock? Insights from 150 Years of Tariff Policy. So if everybody remembers at the very beginning of the show, I talked about how somebody had posted on this and basically said that, yeah, it turns out that tariffs actually reduce inflation and are also likely to increase unemployment. So, but I've got this report here. I just want to show everybody. I am going to be doing an episode on this. So probably in the next, I don't know, depending on time. I've got a lot of stuff that's got to come out this week. So probably sometime in the next couple of weeks, I am going to cover this because this does deserve to be covered. I think this is definitely important enough research and a finding here from the Federal Reserve Bank of San Francisco to basically warrant looking at this a little bit deeper. So ICBA put out another white paper on closing the industrial loan company loophole, which is also known as the ILC banking charter. Now, I've talked about this before. I've done episodes on this in the past. If you want to go check that out, they just put out this little paper that, again, talking about, why preserving the separation of banking and commerce is important. The ILC loophole introduces systemic risk and threatens the DIF, the Deposit Insurance Fund, growth of the ILC industry, and then ILCs increase the consolidation of corporate power and harm consumers. So it's just a short kind of 16-page report. Basically covers a lot of the ground and a lot of the stuff that I've already covered in, like I said, in past episodes and reports that I've done covering this. But again, I just wanted to put it out there if people wanted to go check it out. So, okay. Then we had a short little report here on findings from analysis of nationwide summary statistics for the 2024 Community Reinvestment Act data fact sheet. So this analysis, and again, I'll kind of blow this up here so people can see this a little bit better. See here. So this analysis is based on 2024 data compiled by 3 federal banking agencies, members of the Federal Financial Institutions Examination Council, FFIEC, with the Community Reinvestment Act, CRA responsibilities, the Board of Governors of the Federal Reserve, the Federal Deposit Insurance Corporation, FDIC, and the Office of the Controller of the Currency, the OCC. This analysis was conducted using data compiled for financial institutions reporting under CRA regulations. So, let's see here. And then what did they find? Yeah, like I said, I didn't want to get into the weeds on this whole thing. Loans to smaller businesses and farms, geographic distribution of small business and small farm lending, community development lending. Like I said, not too much. Like I said, this is a pretty short report. I just wanted to point it out there. Like I said, I will cover this either maybe in the live stream next week, or it's not quite enough information for its own episode. But like I said, I'll get to it. Financial stability report. This, I am going to do an episode on this. So this is the semi-annual report from the Federal Reserve. This was the November 2025 report on just the financial stability of the economy. This is a really good report. I like covering this. They talk about asset valuations, borrowing by business and households, leverage in the financial sector, funding risks, near-term risks to the financial system. Usually a lot of really good information in this report. So I will be, like I said, I'll be covering this in an episode. And then finally, White Clay, I did an interview not too long ago with their CEO, Mac Thompson. And, again, I saw that they basically did this kind of co-report with Bank Director, which is called Customer Profitability Insights. And again, just another kind of little 3-4 page report. But I thought there was some pretty good information on this. So I'm going to be doing an episode on this just to cover this, because I think there's some good little tidbits in here that people might find interesting. But like I said, I will bring this one out to people. So like I said, just want to show everybody some of those reports real quick. And now we can get back to the articles and stuff. So I got a whole bunch of tariff news here. I just want to run through with everybody real quick. So obviously, Supreme Court starting to hear the case of tariffs. Now, the Supreme Court in their questioning seemed highly skeptical of the president's ability to just kind of unilaterally just basically put all these tariffs out there on these different countries. I kind of understand, and listening to some of the arguments, I kind of understand where the Supreme Court was coming from. They're worried about what they perceive as kind of a continuing reach in power by the president and the executive branch of the United States government. And I really appreciate that. I can really appreciate that argument. However, I think they need to weigh something a little bit more here in this case. First of all, if they decide that the president does not have the ability to put these tariffs on here, the United States is going to have to pay back this tariff money. this is going to throw us into a massive amount of chaos. This is going to cause, just a immeasurable number of problems. The president's entire kind of trade policy is going to go right out the door. His ability to negotiate and to get better deals from a lot of these countries is going to go right out the door. This is going to have, this has massive, far-reaching complications. And I hope that the Supreme Court really weighs that in what they're doing, because again, I do feel again, some people would make the argument that only Congress, that the tariffs are a tax and only Congress has the ability to levy taxes. Okay, fair enough. You can have that debate, but I think that tariffs are a very unusual form of taxation, and I think that they are a very unique form of taxation, and the president can use tariffs in an offensive capacity, but most of the time they're used in a defensive capacity. Like, in other words, the president has to be able to use tariffs from time to time to save certain industries in the United States. Like, in other words, if they view it, for example, if they view an industry to be of national importance, like national security importance, the president has to be able to act, if they can, with tariffs to save that industry. If the president does not have the ability to do that, that's an enormous problem. That is a huge problem. So again, I just hope that the Supreme Court justices really weigh and measure. Like I said, I understand their concerns. I understand where they're coming from, but I think there is a lot more at play here, and I just think they need to be very, very careful with this one, because this could have far-ranging ramifications, not only now, but for a long, long time into the future. And I hope they think about the fact that, just about every country in the world levies, tariffs against us, and they're able to levy. They're able to, put these tariffs out there on the United States. And if the United States, if the president doesn't have the ability to go back and fight fire with fire and basically say, no, if you guys want to put that tariff on us, that's fine. Then we're going to put this tariff on you. If the president doesn't have the ability to do that, that's going to dramatically hurt the president's ability to negotiate with a lot of these different countries out there. That's just a fact. So I really hope that they consider all angles of this thing and hopefully come to a conclusion. And I'm really hoping that they say that the president does have the ability, as it relates to tariffs, nothing else, just with tariffs, that basically to say that it's a unique thing, and the president needs this ability because he needs to be able to protect the country. He needs to be able to protect certain industries, and he needs to be able to make sure that the United States is not getting taken advantage of by other countries around the world as it relates to trade and tariffs. So, those things go hand in hand. Trade and tariffs go hand in hand. And again, you can't sit there and say that all these other countries around the world don't tariff us. Some of them, like our friends like Canada and Mexico, they tariff the hell out of us. And it's ridiculous. And President Trump tried to use our tariffs to level the playing field, which I think he should have, which I think was the right move. But again, we'll have to see what happens there. So, okay, but that's my soapbox there for the moment. But let's see here. So if Supreme Court orders Trump to repay tariffs, U.S. importers say it wouldn't be messy. So American importers say that if the Supreme Court rules that the money that they have paid for President Donald Trump's tariffs must be repaid, it would be simple to do. Importers pointed to paperwork that clearly details the tariffs they pay on goods brought to the U.S. During oral arguments last Wednesday for a case that will decide the fate of Trump's tariffs, most Supreme Court justices expressed skepticism that the duties were legal. Fair enough. However, I don't really believe this. I don't believe this point. Yeah, okay, they have some paperwork. They say, they charged this or whatever. I don't believe it really is going to be that simple at the end of the day. Like, it might be simple for them. This isn't going to be a simple thing to unravel overall. So again, I hope, like we said before, I hope that I don't want to beat a dead horse here, but I hope they think about that. Now, Bessent, Treasury Secretary Bessent, he says that the U.S. has lots of options to use on tariffs if it loses at the Supreme Court. Yeah, I don't buy. Yeah, I'm not really buying that. Yeah, I'm not really buying that they have all these other options to go to. Yeah, I think he's trying to put a good face on this. He's trying to hedge his bet that, okay, if the Supreme Court shoots this down, that at least I'll have this out there to basically say to people like, oh, hey, don't panic. Like, don't panic. It's all cool. It's all okay. It's not going to be the end of the world. I don't know that they really have all these options out there. I don't perceive them to have all these options out there. Um, Now, the Federal Reserve Bank report that I just showed you a minute ago on 100 that analyzed 150 years of United States tariffs, and what they came back with was that tariffs generally decrease inflation. Like I said, that I've said from the very beginning here that these tariffs were not going to bring about inflation, which they have not. Now, this article, and this must have been painful for the Wall Street Journal to put this article out to admit defeat. You know, how the U.S. economy has defied doomsday predictions on tariffs. So inflation is lower than expected after President Donald Trump's steep levies. So when President Trump announced sweeping tariffs in April, economists predicted surging inflation and raised the odds of a recession. Companies and consumers stockpiled to get ahead of price rises. Those worries now seem overblown. Really, inflation, while too high, is lower than forecasts. And the economy continues to grow despite the steepest tariffs in almost a century. I'm not sure they've mattered as much as people thought they would, said Kelly Kowalski, head of investment strategies at MassMutual. At the same time, the promised benefits of tariffs also largely haven't come to pass. Revenues from Trump's levies have been far lower than the Treasury Department predicted, and there are few signs of a domestic manufacturing boom. I would argue, I would say no on both those accounts. I would say that was absolutely incorrect. I think the revenues from the levies have been far greater in the short term than we thought. I mean, we're getting up to a point now where we're bringing in like $30 billion a month in tariff revenue. What was the tariff revenue before Trump came into office? It was almost nothing. It was like $1 billion a month, and now we're up to like $29 billion a month. Like so. So no, I don't. I think that was a horrible point right there. Is it's not a point. Um, and then as far as this few signs of a domestic manufacturing boom, yeah, that's going to take a while to happen. That's not going to happen overnight. It's not going to happen in 6 or 8 months. Are the wheels in motion? Yes, they are. Are things turning? Yes, they are. Are you going to start to see the realization of that manufacturing boom in 26, 27, and 28? Oh, yes, you are. Yes, you are. And I'm going to show you a couple articles here in just a second as we get through some of this other news here. So, but the point here of this article is the point that I've been driving home all year long, that the tariffs were not going to lead to massive inflation. The tariffs were not going to destroy the economy. The tariffs in the short run were going to raise us a tremendous amount of revenue, which they have. The tariffs in the long run are going to bring us back a whole bunch of manufacturing, which we don't have today, which is going to be a boon into the future. They have the Trump administration. It's mind boggling. They have lined up trillions of dollars of investment into the U.S., manufacturing investment into the U.S. When that hits, the GDP is going to be going like gangbusters for a few. We have in the years ahead, we are going to have some really incredible years ahead of us. We really are. And it's gonna be a good thing to see. Now, in the short term, I would say over the next 12 months, we really got to watch the labor market. We got to watch what's going on there. But anyway, I digress. Okay, so U.S. reaches framework trade deals with Argentina, Guatemala, El Salvador, and Ecuador. So the agreements will provide tariff relief on certain goods while opening foreign markets for U.S. goods, a senior administration official said. Again, great job. More trade deals done with 4 countries here in South America. Great news to hear. Fantastic. Trump removes tariffs on beef, coffee, and other agricultural products. The White House cited substantial progress in recent trade negotiation while announcing the change. Again, really good news there. That's really going to help. U.S. and Switzerland reach a tariff deal that lowers duties on Swiss goods to 15%. Under the deal, Washington gains expanded access to markets in Switzerland, and Swiss firms pledge $200 billion in U.S. investments. There you go. More money into the U.S. investments. So again, a great deal, I think, for both the U.S. and Switzerland there. Why? Now, here are the two articles I just mentioned. Why Jeep and Ram parent Stellantis is investing $13 billion in the U.S. So the $13 billion investment is Stellantis's largest so far. The company lost 5% U.S. market share in about 5 years. High prices and stale product had driven customers away. So automaker Stellantis is making $13 billion bet on a U.S. comeback after a rough 2024 with a $2.7 billion net loss in the first half of 2025. High prices and stale products scuttled what had been a highly successful first few years of the combined company. Stellantis was the product of a merger of French company Peugeot and Italian-American company Fiat Chrysler. Joining forces allowed the automakers to save more than $8 billion through sharing parts and streamlining operations, roughly double what the deal had promised investors. But even though inventory shortages across the industry kept sales strong, many of the core buyers of Jeep, Ram, Dodge, and Chrysler were turning away. A lot of automakers during the pandemic really raised pricing. During that time, Stellantis was losing market share, dropping about 5% U.S. market share in about 5 years. Stellantis with a new plan that aims to recapture its previous status with its $13 billion investment. About a tenth of that is so far dedicated to tooling up U.S. factories for new and existing models. That's also a sign that the company is trying to escape costs associated with tariffs on imported vehicles, experts say. Stellantis earlier this year said trade barriers stand to cost it $1.7 billion in 2025. So they are going to bring the manufacturing back to escape the cost of tariffs. And it's going to, economically, it's going to make sense for them to do so. Next article here. GM wants parts makers to pull supply chains from China. Oh, this is interesting. According to Reuters, General Motors has directed several thousand of its suppliers to scrub their supply chains of parts from China. 4 people familiar with the matter told Reuters, reflecting automakers' growing frustration over geopolitical disruptions to their operations. GM executives have been telling suppliers they should find alternatives for China for their new raw materials and parts, with the goal of eventually moving their supply chains out of the country entirely. The people said the automaker has set a 2027 deadline for some suppliers to dissolve their China sourcing ties, some of the sources said. GM approaches some suppliers with the directive in late 2024, but the effort took on fresh urgency this past spring during the early days of an escalating U.S.-China trade battle. So again, you have GM here telling thousands of their suppliers that, hey, you need to pull your stuff out of China. And they say other countries, but if they face tariffs, where do you think they're going to go? They're going to come here. They're going to come back to America. So this is you are, like I said, you're just beginning. This is just the beginning of this effect from the tariffs. You're going to see this stuff begin to roll in. And it's going to be, when it finally hits, it's going to be fantastic, but it's going to take a little time. All right. Enough about tariff stuff. I'll tell you what, with the amount of articles and stuff that I have left to go over, I'm probably going to run over at least about another, 10 minutes or so. So if you guys can hang with me for another 15 minutes here, I get through all this stuff. All right, so let's talk about the labor market for just a few minutes here. So hiring outlook for college graduates is the worst in 5 years, U.S. employers say. So despite AI's impact on entry-level employment, 61% of employers noted that they are not replacing junior roles with AI. The U.S. labor market may not be in great shape for college graduates when they receive their diplomas in the spring, according to a new National Association of Colleges and Employers report. Employers are bracing for 2026 to deliver the toughest job market for college graduates in 5 years, with more than half, 51% of the surveyed 183 employers rating the job market as poor or fair. This represents the worst outlook for employment conditions since the onset of the pandemic. So yes, so not looking good here for college graduates. 5,000 job openings with 6-figure salaries remain unfilled at Ford, as per their CEO. The country is facing a critical manufacturing job crisis, said Ford CEO Jim Farley. So let me repeat that again, 5,000 job openings with six-figure salaries. So if you're out there, if anybody knows somebody who's looking for a really good paying job, I highly suggest you figure out what jobs Ford is offering right now at these six-figure salaries and go get some training to do that job. Ford has 5,000 job openings for mechanics offering a six-figure salary, a sign of skilled manual labor shortage facing the United States, the company's CEO, Jim Farley, said in a November 12 interview on the Office Hours. We have over 1 million openings in critical jobs, emergency services, trucking, factory workers, plumbers, electrician, and tradesmen. It's a very serious thing. We do not have trade schools. We are not investing in educating the next generation of people like my grandfather, who had nothing, who built a middle-class life and a future for his family, said the Ford CEO. As of this morning, we had 5,000 openings, a bay with a lift and tools, and no one to work in, he said to a podcast host, Monica Langley, referring to job positions at Ford. $120,000 a job a year, but it takes you 5 years to learn it. Take a diesel out of a Super Duty. It takes a lot of skill. You need to know what you're doing. Super Duty refers to trucks, Ford's truck offerings. So again, and again, this speaks to a much larger issue, and the fact that we do have tech schools, like, what would you call them? Like when I was in high school, they called them like VOTech, vocational technical institutes, that a lot of high school kids. The problem is that at a lot of these technical schools that do work with a lot of high schools in a lot of counties and states around the country. As I said at the beginning of the show, I was in New Orleans, and New Orleans has parishes. They do not have counties; they have parishes. And what is, but you have a lot of these Votex little schools out there that do this, but they are very limited in their funding. They have, like, in other words, like, you might have 200 kids that want to go in. They might only have spots for 20 or 30 kids. So we need to dramatically alter. If we're going to bring a lot of this manufacturing back, we already have this dearth of tradespeople. We need to dramatically alter the way that we are educating kids, and we need to dramatically expand the funding for these trade schools to get these people, trained as skilled workers in all these different trades, and get these people back to work. We have a lot of people. We have 6-7 million men in this country that aren't working right now. Okay. What do you think they could be doing? Hello, right here. They could be doing this. So again, we need to, we've put so much emphasis for so long on everybody's got to go to college. Everybody's got to go to college. Well, now we're finding out that was a big mistake, and we shouldn't have been doing that. And I would say that the data, 60%, for people who don't know, 60% of the people that go to college don't graduate. 60%. Yeah, it's more than half. Which tells you that there's a lot of people that probably shouldn't have been in college to begin with. But that's where they got shoved. That's where they got shoved, because all the schools are incentivized to send as many kids as they possibly can to college. So we need to really talk about the education system, how kids are getting educated, what it is they're spending their time doing, because some of this stuff's got to change. It just has to. And then here we got inside the frantic push to reverse Verizon's decline. So after the board soured on Vans Vestberg's, where did this guy come from? Look at this guy. Network first focus. His successor as CEO is planning major job cuts. The thing I wanted to point out here is that Verizon is basically going to let go of like 15,000 people. Yeah, executives are planning aggressive cost cuts internally that are likely to result in the reduction of about 15,000 jobs. The Wall Street Journal reported on Thursday. Verizon currently employs roughly 100,000 people. So so they're going to be cutting a lot of jobs here. Not a great thing here. Verizon is going to be cutting a lot of jobs. So, okay, small business owner optimism just hit a 6-month low, and here is why. So, a monthly survey of small business owners showed optimism decline in October for the second straight month to its lowest level since April, with respondents citing worries over the government shutdown. Small businesses reported difficulties hiring qualified candidates, while sales and the profit levels were also lower in October. Well, I would say this now that the government shutdown is over, some of that anxiety, some of that worry is going to start to go away. I wouldn't be surprised if this number pops back up in November and December, but we shall see. So, all right, a couple things on the mortgage front here. So, the Trump administration this week is considering 50-year mortgages. I no, no, I just somebody could make the argument, and I saw this argument made online this week. Okay, that you could have, the 50-year mortgage is just another payment option, right? Just as you could get a 30-year mortgage, you could get a 20-year, 15-year mortgage, 20-year mortgage, 30-year mortgage. It's just another payment option, okay? And it's one that would allow you to have a lower monthly payment. Yes. However, I mean, 50 years. I mean, oh my gosh. I mean, dude, they seriously want you working until you're 100 years old to pay off your mortgage. I mean, it's just crazy. And the amount of interest that you would end up paying the bank in a 50-year mortgage is beyond ludicrous. So I no, am I a fan of this idea? No, I really am not. And then they had another humdinger this week. So the Trump admin considers what's called a portable mortgage. In other words, it's also known as an assumable mortgage. Now, assumable mortgages were a big thing many years ago. They were very popular at kind of the end of the 70s and throughout the 80s, where people could just assume your debt. They could just assume the mortgage. However, in the last, 25 years, 30 years, they've really fallen out of favor, and very few banks will allow you to do an assumable mortgage. It's even in the loan documents, which basically says like, no, we're not going to allow you to assume somebody else's mortgage. And there's a lot of reasons for that. Like, you don't want, as a banker, I don't want somebody to just take their loan and just give it to somebody else. And then I'm like, I have no idea like who they gave it to. Can that person even afford to repay me? No, absolutely not. Like, I do not want to open that Pandora's box. Do not want to go down that road. Here's another interesting thing here. Underwater mortgages rise to a 3-year high amid cooling U.S. housing market. So data also show the number of highly unqualified or highly qualified refinance candidates rose to 1.7 million in late October, the largest since early 2022. So underwater mortgages are starting to rise up a little bit. We also see this. New foreclosures jumped 20% in October, a sign of more distress in the housing market. So foreclosure starts, which are the initial phase of the process, rose 6% for the month and were 20% higher than the year before. Completed foreclosures, the final phase, were up 32% year over year. Florida, South Carolina, and Illinois led the nation in state foreclosure filings. And then we have this, U.S. home turnover hits the lowest rate in decades. So only 28 out of every 1,000 single family homes have been resold this year. So the number of existing homes owned by people, very little turnover amongst existing homeowners. So only 28 out of every 1,000 U.S. single family homes have been resold this year, making it the lowest turnover rate since the early to mid 1990s, according to online real estate brokerage Redfin. In its October 31st analysis, Redfin also stated that home sales this year were down by 38% from the COVID-19 pandemic peak year of 2021 and by more than 31% from the last pre-COVID-19 pandemic year 2019. So Redfin defines the turnover rate as the number of homes sold during the first 9 months of the year divided by the total number of sellable homes on the market. So again, just very interesting data. Now, a couple more things here on the home builders are offering mortgage rate discounts, but home buyers are not biting. So new homes are sitting unsold despite builders using sweeteners to shift inventory. America's biggest builders are struggling to sell homes even when they offer buyers a 4% mortgage. Their experience suggests rate cuts alone won't be enough to boost weak sales in the wider housing market. The number of completed but unsold new homes has reached levels last seen in the summer of 2009. Data from the Federal Reserve Bank of St. Louis shows at the end of last year, builders were confident that sales would recover in 2025 and build tens of thousands of units to have enough supply for the spring buying season, but demand didn't pick up and more homes sat unsold. And we can see from this chart here, number of completed but unsold new homes has really jumped up here. 123,000 homes are sitting basically uncompleted, basically the highest that number has been since about 2009. Pretty crazy right there. And then we've got, I think this is the last of the builder articles here. So builders' cheap mortgages are a bad deal for home buyers. People who borrow from a builder are more likely to overpay for their property and be underwater after they move in. So there you have it. So we went from builders are offering mortgage rate discounts, but home buyers aren't biting, to builders' cheap mortgages are a bad deal for home buyers. And now you know why the home buyers aren't biting, because they're probably overpaying for the property, and then they're going to be underwater after they get into that bad boy. So, okay, let's just look at a little bit of bank news here real quick before we get out of here. So TD Bank to close 51 branches, including 6 in the Philadelphia area. So TD Bank still operating under that asset cap, like they continue to close a number of branches. The Synapse bankruptcy case got tossed. So I've talked a lot about Synapse fintech, financial technology. So some users of Synapse's fintech partners, such as Yoda and Juno, have posted on a subreddit thread that they're still personally owed thousands of dollars. So a judge tossed the Synapse Financial Technologies Chapter 11 bankruptcy case on Wednesday, 19 months after the company's collapse locked customers out of up to $95 million of their own funds. Judge Martin Barash granted bankruptcy trustee Jelena McWilliams' request to dismiss the case, which she made in June on the grounds that Synapse lacked the funds to repay creditors and that efforts to sell its assets yielded no viable bidders. Many end users of Synapse financial partners, such as Yoda and Juno, have yet to get their funds back. Some users of the r/Yoda subreddit, which has been the de facto online meeting place for users locked out of their Synapse-tied funds since April of 2024, have posted within the past 24 hours that they are personally owed thousands of dollars. One user said 63,000, 2 more 30,000, another 10,000. So yes, this continues to be a major problem here, but the judge has tossed the bankruptcy case. Open banking lurches forward. So again, banks and fintechs are connecting digitally to share data amid litigation over a rule to spur competition for financial services. So yes. So again, yeah, we're going to keep an eye on this one. I'm not, like I said, I'm not a fan of open banking. Do not like it. But yet it is continuing to hang in there. Fed eyes a 30% cut in supervision regulation unit. So the central bank aims to use attrition, retirement, and voluntary offers to cut the division's workforce to 30 to 350, particularly targeting management layers. So the Fed looking to make reductions. The OCC's Gould leans away from ostrich approach. So under Jonathan Gould's leadership, the agency aims for a more balanced approach to innovation and not a focus on a parade of horribles. So interesting stuff there. Thrivent Bank aims to pair advice and digital platform in a youth push. The only institution to get an actual ILC charter during the Biden administration seeks to deliver its parent company's brand of advice earlier in a customer's lifespan. So the CEO, Brian Milton, said. The CFPB cries poor, but also tweaks fair lending and data collection. So a Justice Department office argued the Fed has no money to fund the Bureau, but the CFPB's acting director hasn't asked the central bank for money anyway. So the Consumer Financial Protection Bureau proposed 2 rules for publication Thursday in the Federal Register, one arguably weakening fair lending laws and the other following through on a promise to revamp small business data collection guidelines. That's what I talked about with the 1071 rule earlier. That irked Republican lawmakers and drew a lawsuit and at least 2 enforcement delays. The week's boldest CFPB-related move, though, may have come from the Justice Department's Office of Legal Counsel, which told CFPB Acting Director Russ Vogt in a memo that the Bureau may not legally request funds at this time from the Federal Reserve under the Dodd-Frank Act. So again, very interesting. We'll have to keep an eye on this and see what happens. Walmart CEO Doug McMillan. It should be McMillian, right? Doug McMillan to retire in January after nearly 12 years of leading the retailer. Let's see here. What else we got? A couple more things here. Disney drops DEI terminology from annual report for the first time in 5 years. The move comes amid a federal probe into the company's diversity practices and investor scrutiny. So, yep, Disney continues to be under fire and continues to move out of there. Let's see here. China registers worst investment decline in years as the slowdown continues. So consumption also slowed, with retail sales on their longest run of decelerating growth since 2021. So yeah, China's economy is not doing very good at the moment, and we'll continue to keep an eye on that. And what are the last couple things? Yes, IRS unveils Roth IRA income limits for 2026. So the IRS announced Roth individual retirement account contribution and income limits for 2026. For 2026, investors could save a maximum of $7,500 in their Roth IRAs, up from $7,000 in 2025. The IRS also boosted IRA catch-up contributions for investors aged 50 and older to $1,100, up from $1,000 in 2025. And then finally, the IRS has announced higher 401k contribution limits for 2026. Starting in 26, employees can defer $24,500 into workplace plans, up from $23,500 in 2025. Only 14% of participants maxed out 401k plans in 2024, according to Vanguard's 2025 How America Saves report. So, and let's see here. Did it? Nope. That is all I had. So, okay. All right. Well, I thank you guys for hanging in there with me an extra few minutes. So let me go into wrap up mode here. I'm going to give you guys our story of the week and then also our quote of the week. But before we get into that, I want to just go over where my banners here. Got to hit my banners here for a minute. So, okay. So I just want to tell everybody. So reviews. If you're listening to this podcast on Apple Podcasts or Spotify, please leave me reviews. They really help the channel. Could really use those. Make sure to visit thebankernextdoor.com. Got a lot of great stuff on the website. If you're looking for any of the particular episodes or anything like that, you can go on there, check them out. But like I said, please check out the website when you get a minute. Make sure to subscribe on YouTube to get the latest, just to get the latest updates from me. Like, in other words, I usually put out a couple of posts every week. Usually on Sundays, I post the episodes that are coming out this week during the week. I like to update everybody on if there's any changes to the strategy room and when that is going to be. If it's not going to be at the normal time on Saturday nights at 8 o'clock, if I'm moving it to Friday night or whatever, I try to let people know that. If you have, let's see here, if you have any questions or comments, make sure you can email me at info@thebankernextdoor.com. I'm always looking for topic suggestions. If there's anything in particular that anybody would like me to cover, you can send me an email at that address. You can follow me on social media on Getter, True Social, and X. I spend most of the time on X. So if people want to look for me, you can definitely find me on there. I just remind people that BND is on YouTube, Rumble, and all major podcast platforms. We post new episodes every week, Monday through Friday, premiering at noon. And the BND Strategy Room live stream is every Saturday night at 8 p.m. So, okay, those are all of my reminders. Now, let's go to our story of the week. So our story of the week this week is called tapering. So tapering refers to policies that modify traditional central bank activities. Tapering efforts are primarily aimed at interest rates and at controlling investor perceptions of the future direction of interest rates. Tapering efforts could include changing the discount rate or reserve requirements. Tapering may also involve the slowing of asset purchases, which theoretically leads to the reversal of quantitative easing policies implemented by a central bank. Tapering is instituted by QE policies have accomplished the desired effect of stimulating and stabilizing the economy. Tapering can only be employed after an economic stimulus program has already been enacted. So that is tapering, which is one of the tools in the toolbox of the Federal Reserve. So, and now finally, our quote of the week. So now I pulled this out just for a little bit of context. There, if anybody has not watched it yet, there is a great four-part series that is on Netflix right now called Death by Lightning. It is all about the assassination of President James Garfield in 1880, and it was fantastic. I give it four stars out of four, 4 out of 4. An incredible cast, great cast of actors. Just really well done. It was entertaining. It was funny, well written, well acted. So again, if you haven't seen it, go out and see that show on Netflix. It really was fantastic. And with that being said, I decided that I was going to do a quote from President James Garfield. So the quote here this week is, "Next in importance to freedom and justice is popular education, without which neither freedom nor justice can be permanently maintained." And that was from President James Garfield. So there you have it for this week. I thank everybody for hanging out with me. It was great to be back this week. I missed you guys last week. But we're back in. And I thank everybody for watching. Again, remember, I got episodes coming out all this week. There's probably going to be a Strategy Room bonus episode coming out tomorrow. Keep an eye for that, maybe around 12 o'clock, just saying. But anyway, I thank everybody for listening. I thank you for being a part of the podcast. It really means a lot to me, and everybody here at BND for that matter. So, and like I said, look to see everybody again next week. Have a great weekend out there. Be safe, and I will see everyone again real soon.